All right, so we are doing a question on the audit risk from your Kaplan kit, and this is the question number 201. And you focus on the name of the question because you may have a different number within your kit. So the name of the question is the Harlem, which we are doing now. And let's go to the requirement first. The requirement is we will stick to the requirement related to the audit risk and the responses. Calculate the four ratios listed in the table below for both years to assist you in planning the audit of the Harlem company. Now, whenever there's such type of requirement within the F8 exam or the A exam, these are the absolute free marks that you can get because you just need to apply your F7 knowledge, just calculate the ratio and you will get straight away marks for it, even if you are not relating it with the audit risk, because obviously we are supposed to relate with the audit risk, but that is in the next requirement. Even if you are not relating it, still you will get these marks. All right, so gross profit margin, what is the formula of it? GP, it is the gross profit, divide by the sales into 100. This is the formula of calculating the gross profit margin. And then we have the inventory holding period, that is inventory. We have the inventory figure, divide by the cost of sales into 365. And then we have the gearing, how the gearing is being calculated. This is basically the debt over debt plus equity. So we have the debt thing compared with the debt plus equity. And then we have the interest cover, which is profit before interest and tax divided by the interest. Profit before interest and tax divided by the interest. So this is how you are going to calculate the interest cover. Now these are the four ratios that you need to calculate. Okay, and then we have the requirement number C. Using the information provided and the ratios calculated, describe 8 audit risks and explain the auditor's response to each risk in planning the audit of the Harlem company. Now, using the information provided. Now, using the information provided is what you have in the case study. This is the case study information and the ratios calculated. Now, these are the ratios, like the gross profit margin of 2 years, inventory holding period. Now, obviously, if inventory is increasing, inventory days are increasing, then that means that company is struggling to sell the inventory. And accordingly, inventory should be recorded at lower of cost for NRV. If, for example, if it is not recorded at NRV, then inventory may be overstated. Similarly, we have the debt and the debt plus equity thing. We have the interest cover thing that may give some information to us regarding that. So these are, the ratios we are supposed to calculate in 4 marks, and from the information given and the ratios calculated, we are supposed to identify. Now, the case study line will give you the separate information. You can write separate risks related to the ratios as well, like I've given you the example of inventory days. Or you can relate the case study information with the ratio calculated, and you can write the risk related to that as well. We'll see when we read the question now. And explain the auditor's response. Now, auditor's response is the auditor's action towards the assessed risk. So it is simply the auditor's action, or you can say it's simply an audit procedure. So 8 audit risk in the case study. Okay, let's read it. It is 1st July 2005, and you are an audit supervisor of the Brookline and Company, and are planning the audit of the Harlem Company for the year ending 30th September 2005. The company has been a client of your firm for several years and manufactured car tires, selling its product to the wholesalers and retailers. The audit manager attended a planning meeting with the finance directors and provided you with the following notes of the meeting and the financial statements. All right. So basically, they sell the car tires to wholesalers and retailers. Harlem Company sells approximately 40% of its tires to the wholesale customers. Fine. These customers purchase goods on a sale or return basis. Now, you know this arrangement sale or return basis from your F7 exam. And even if you not remember, let me give you a flavor of that. That we are giving them the tires and we're saying if you sell it, give us the money. If you are unable to sell it, you will be returning us the tires. So that means we cannot record, or the company cannot record the sales unless and until they have sold the goods. Because when we are giving them the tires on the sale or return basis, unless and until they have sold those tires, we won't be able to record the revenue because it's a sale or return basis. So the revenue and the related cost of sale should only be recognized when that means it is probable that the goods will not be returned. Because IFRS 15 is a relevant standard here, and it says that the revenue should be recorded. There's a 5-step model for that. COPAR. This is the acronym to remember it. So C stands for the contract. Within the contracting, the first step of the IFRS 5, it says that revenue can only be recorded if it is probable that economic benefits will flow to the entity. So if you think that the goods will be returned, then you cannot record the revenue straight away. So there is a risk that revenue may be recorded even if it is probable that the goods will be returned. Under the terms of the engagement or agreement, wholesale customers have 60 days during which any returns can be made without penalty. The finance director has historically assumed that a return of 10%. However, he now feels that it is excessive and intends to change this to the 5%. So they initially assumed that, okay, 10% of the tires will be returned. And now they are saying that the return percentage is going to be the 5%. So according to IFRS 15, the revenue and the related cost of sales can only be recorded that if it is probable that economic benefits will flow to the entity and the returns will not occur. So there is a risk that they may record the revenue even if it is not probable that the economic benefits will flow to the entity. So initially, now, if you talk about the accounting, what they should do is if they are getting the cash, what they're going to do is debit the cash and credit the liability, the deferred income, the liability, because they cannot record the revenue unless and until it is being confirmed that they have sold the goods. And obviously, when the goods are being sold, then they are going to de-recognize their liability and record the revenue. So this is the first risk we have right in front of us. We'll be writing that in a while. The company purchased a patent on 30th September for 8 lakh, which was capitalized as an intangible asset. Okay, fine. So the patent gives Harlem Company the exclusive right to manufacture specialized wet weather tires for 4 years. So that means the patent should be capitalized an intangible asset, and because it has a definite life, it should be amortized over the years, over the 4 years. Every year amortization should be charged. So there's a risk that incorrect amortization may be recorded, resulting in the overstatement of the assets and profits. In preparation for the manufacture of the wet weather tires, this year a company conducted a review of its plant and machinery. As part of this review, surplus items of plant and machinery were sold, resulting in a loss of disposal of 160,000. And we have studied audit risk table, and I told you there will be so many risks covering from that. So they have sold some of the property, plant, and equipment. It should be de-recognized from the asset register, and the loss on disposal should be recorded within the profit or loss. So there is a risk that the asset disposed may not be removed from the asset register, or incorrect losses may be recorded within the financial statements. And you see there is a significant loss. Now, how the loss is calculated? Raw loss is the difference of the carrying amount and the proceeds. So they're having a significant loss. That means their carrying value is significantly more than the proceeds, which gives us the evidence that the depreciation they were charging was not correct. This gives us the evidence. Although it is possible, that the fair value changes significantly and it may occur a significant loss, but it suggests that significant loss means that their carrying value is significantly more than the proceeds, and that gives us the flavor that their depreciation charge may be incorrect. This is an indication that they may not be charging the depreciation according to the correct rates. So their depreciation may be understated as well. Okay, in 20x5, May 20x5, the financial controller of Harlem Company was dismissed after it was alleged that she had carried out a number of fraudulent transactions against the company. All right, so she was alleged to be doing the fraud in the transactions. So the transactions, if they are not uncovered, so that means they are still included with the financial statements, and the financial statements may include the fraudulent transactions, and as a result, financial statement may be misstated. So she has threatened to sue the company for unfair dismissal. So if the outflow is probable, the provision should be recorded. If the outflow is possible, contingent liability should be disclosed. If that is not the case, provision and contingent liability may be misstated. The company has only recently started to investigate the extent of the fraud in order to quantify. They have just started it. That means they have not uncovered it. So that means that fraud is still part of the financial statement. And if that is not uncovered, then the financial statement may be misstated in that regard. The problem occurred in June 2005 during production of a significant batch of tires, which affected their quality. The issue was identified prior to any goods being dispatched, and management is investigating whether the issue can be rectified and tires can subsequently be sold. So they're having the problems within their tires. So accordingly, inventory is2 says that it should be recorded a lower of cost NRV. The NRV of the affected tires is probably lower than the cost. If they are still recorded at cost rather than NRV, then the inventory is overstated. Harlem Company Finance Directors informed you that in March 2005, a significant customer was granted a payment break of 6 months, and it has been experiencing financial difficulties. Harlem Company maintains an allowance for trade receivables, and it is anticipated that this will remain the same. So they have given an extended credit term to a particular customer. Accordingly, they should book an allowance for receivable against that. If the allowance is not increased, then receivables may be overstated. Okay, then we have this thing. Okay, we have another paragraph. The report of the management issued by Brookline Company following the last year audit highlighted significant deficiencies relating to the Harlem Company purchases cycles. Their purchases system is weak. Now, purchases system produces two figures. Purchases system produces the figure of the purchases, which eventually becomes a part of the cost of sales, and then the corresponding payable, which is the liability. So if they're having the deficiencies within their purchase system, then that indicates that their purchases and the corresponding payable figure may be misstated within the financial statements. The finance director has informed you that the company intends to restructure its debt finance after the year end and will be looking to consolidate its loans to reduce the cost of the borrowings. As a result of planned restructuring of the debt, Harlem Company has not paid its shareholders a dividend this year, choosing instead to undertake a bonus issue of its 0.50 equity shares. Now, there are two things within it. The first one is they are restructuring their loans. So why they are restructuring it? The company intends to restructure its debt and will be looking to consolidate its loans to reduce the overall cost of the borrowing. So basically, they want restructuring within their loans, and the relevant ratio is the gearing ratio that we need to say that they may be seeking for the loans So in order to get the further loans, they may manipulate the financial statement. They want the financial statement to look, uh, properly sugar coated, so that the banks are giving them the loans easily. And they have done the bonus issue. Now we know the bonus issue is the free issuance of shares to the existing shareholders. So the bonus issue is basically the double entry, or the accounting treatment is that they are usually done either from the share premium, or if there's no share premium, then they are done from the reserves. So either the debit goes to the share premium or the reserves, and credit goes to the share capital. This is the treatment of the bonus issue. So there is a risk that incorrect treatment may be performed in relation to the bonus issue, and equity may be misstated as a result. You have been asked by the audit manager to perform the preliminary analytical review, where you're supposed to calculate the ratios. So what we can do is, we were having these ratios within the question. So we have the gross profit margin. So the gross profit for 2 years, the gross profit divided by sales into 100. So simply 4,600 divide by 21,900. So we can just simply do that. 4,600 divide by 21,900 into 100. So we have this 21%. So GP is 21% over here. We can do the other one. 4,500 divided by 23,200. And again into 100. So it's 19.3965%. So that means 19.4%. Okay, so we are done with it. The next ratio was the inventory holding period. So inventory divided by the cost of sales into 365. So 1,600 divided by the 17,300 into 365. Okay, the next one is 2,100 divided by the 18,700 into 365. So we can calculate this. All right, so 1,600 divided by 17,300 into 365. So we have 33 points, but the days are never in the points, so we are going to round it off. So it gives you 34 days. Sorry, the next one. Yes, 2,100 divided by 18,700. Sorry, 18,700 into 365. So it gives you 41 days. All right, so we are done with the two ratios. The next one is the gearing, which is you can calculate the debt over debt plus equity, or the debt over equity. So both are calculated. So what we can do is simply, what is the debt? 11,000. So 11,000 divided by 11,000 plus 9,500, debt over debt plus equity. And over here it is 13,000 divided by 10,000 plus 13,000 and into 100, obviously, because we need to have this in the percentage. So first of all, this 11,000 plus 9,500. So we have, sorry, 20,500. All right, so 11,000 divided by 20,500 into 100. So it is 53.7%. Is in the financing of the company, 53.7% is the debt in 20x4. And let me check in 13,000 divide by 23,000 into 100. So we have 56.5%. So the debt is increasing. So that it means they are seeking further loans, and in order to seek further loans, they may manipulate the financial statement, 56.5%. Okay, so the last one is the profit before interest and tax divide by the interest. So the profit before tax, we need the profit before interest and tax. So we need to add back the interest. So 850 plus 250 divide by 250. And then we have 450 plus 290 because we need the profit before interest and tax. And this is profit before tax, divide by 290. All right, the last one we can calculate it this. 850 plus 250 divide by 250. So it is 4.4 times. Okay, remember that 4.4. 450 plus 290 divide by 290. So it is 2.55 means 2.6. So it was 4.4 times earlier, and this is 2.6 times. So that means the interest cover is decreased. So that keeps the pressure on them to manipulate the profit, because obviously with low interest cover, they cannot get the loans from the bank. The bank will never give them the loans with the low interest cover. So that keeps the pressure over the management to manipulate the profits in order to get the loans. So this was the complete question. Okay, so we have another thing. The audit assistant has already calculated some key ratios, which we have confirmed as accurate. She has ascertained that the trade receivable collection period increased from 38 to 51 days. So that is probably because they granted the extended credit terms over here, 6 months break to one of their customer. So as a result, the allowance should be increased. And if they're not increasing the allowance, then the receivables are overstated. So this is how you are going to deal with the question. Okay, now we can just attempt it by writing the audit risk. And the response in the exam, you will be having a constructed table over there, and you need to write the audit risk. First of all, start with the case study line. So we'll be writing the case study line first. The finance director has, decreased the return rate from 10% to 5%. The finance director has decreased or reduced the return rate from 10% to 5%. Now, for example, if you remember the standard correctly, then you can write according to the IFRS 15, writing the revenue from the contracts with customers. But if you do not remember the name or the number of the standard, then there's no need to write the incorrect one. That will affect the impression of your expression, your answer basically. So what you can do is simply, I'm writing it for you according to the standard. There's no need to write the name and the numbers. So according to the relevant standard, you just write the relevant standard. No need to write the name and the number because you won't get any marks for it. So according to the relevant standard, revenue and the corresponding cost of goods sold should only be recorded when it is probable that economic benefits will flow to the entity. And there will not be the reversal of revenue. So this is what the standard says. The goods are sold on sale or return basis. There is a risk that revenue and the cost of sale, they do not write CUS in the exam, write the full cost of sale. There's a risk that revenue and the cost of sales may be recorded even the criteria is not met, resulting in the overstatement of revenue and understatement of liabilities. How the liabilities understated? Because obviously the revenue collected should be recorded as a deferred income. So if they're directly recording it as the revenue, then the revenue is overstated. So they're decreasing the estimate of the return from 10% to 5%. Remember, whenever we have anything related to the accounting estimate, anything, whether it is provision, whether they are allowances, whether they are depreciations, anything related to the accounting estimates, any accounting estimate, the most appropriate procedure is the first one is discuss the rationale, or we call it as a basis. Discuss the rationale or the basis. That means why they are reducing. What is the logic behind it? Rationale or the basis means the logic. Discuss the rationale or the basis of decreasing the return percentage with the finance director and assess the reasonableness, because accounting estimate should be reasonableness of the accounting estimate, reasonableness, whether the change is being made in accordance with the standard. So you just ask them the rationale. Additionally, what you can do is review the previous year's return percentages to confirm the reasonableness of accounting estimates. Because in the previous year, for example, if they had, let's assume something around 5% or less than 5%, then it is fine, because obviously they are right to reduce it, because in the previous year they had something related to 5% or near to the 5%. Then we had the patent thing after that. So the company purchased a patent for 8 lakh. Patent was purchased for 800,000, which gives the company right of what? Right to manufacture the tires for 4 years, right to manufacture the tires for 4 years. This is the case study line. I have summarized it. You are supposed to do the same in the exam, or you can just copy paste from your case study line. And okay, so according to the relevant standard, if you remember, you can write according to IS 38, otherwise according to the relevant standard. Patent should be capitalized as intangible asset and be amortized over 4 years. Now the risk, there is a risk that incorrect amortization may be recorded, or you can say there's a risk that the patent may still be recorded at cost rather than the carrying value. You can write this thing in this way as well. So there's a risk that incorrect amortization may be recorded, or you can write there's a risk that amortization may not be recorded at all. You can write it anyway. So there's a risk that incorrect amortization may be recorded, resulting in the overstatement of assets and profits. Now, what is the response? Again, discuss with management regarding the amortization of patent, recalculate the amortization and agree the figure to the financial statement. So this is how you can write the response of the patent. Okay, let me write one related to the ratios. So let's just write this one, which was a payment break of 6 months was given to a customer. A payment break of 6 months is given to a credit customer. And now you relate with the ratio with it. Accordingly, the receivable days have increased from 38 to 51 days. Accordingly, receivable days or receivable collection period have increased from 30, how much? 38. Okay, so 38 to 51 days. Allowance for receivable should be increased to reflect such change. Receivables may be overstated, or receivables are overstated if they are not provided against. If they are not provided against, that means that the allowance is not increased. Or you can also write if the allowance is not increased. You can write it either way. So receivables may be overstated if they are not provided against. Again, this is an estimate. So there can be multiple responses related to that. So the first one, discuss with management, because they're saying the allowance will not be increased. It is being written over here. It is anticipated that this will remain as the prior year, so they are not increasing the allowance. Again, discuss with finance director the reasons for not increasing the allowances. And then increased testing should be performed, year-end testing should be performed on, increased testing should be performed on the year-end receivables. So this is how you are going to attempt the question. This is how you're going to attempt the audit risk question. So in audit risk, you start with the case study line, then you write the treatment and the risk and the effect on the financial statement. The response is the auditor's action towards the assessed risk. So this was a very, very, very good question from your Kaplan kit. And now attempt the remaining one and send me the answer and I will review it, how it is being done. So Harlem Company from your Kaplan kit, and this is question number 201.